There's an African proverb that says, if you want to go fast, go alone. If you want to go far, go together. However, I think that in real estate investing, partnership can actually help you go faster and further. Today, I want to share with you 4 common partnership models in real estate investing. Disclaimer, I am not an attorney and I am not a CPA. So if you choose to move forward with any of these models, definitely check in with the professionals to understand all the ins and outs of setting up the right structure, getting the right paperwork in place, and what your tax implications could be. However, I hope that today's video will help you understand at a high level 4 of the common partnership structures and give you some ideas for how you might structure your first or next real estate deal. Let's get started. Partnership option number 1, joint venture. There are a few key attributes to a joint venture: shared ownership, shared governance, shared risk and reward, and defined purpose and duration. So what do these things mean? Shared ownership basically means that even if someone who's entering the joint venture is bringing all the money and doing nothing else, they're not a lender. It's not a debt. They have ownership. Everyone in a joint venture has ownership in the project according to whatever your JV agreement is. Shared governance means that you're also sharing the decision-making responsibilities. Shared risk and reward means that you all have equity or ownership in the project and the property, and at the end of the project, you split the proceeds or the losses according to what your agreement says. Whether that's 50-50 or 75-25, you'll make sure you outline that in advance of the project getting started. And define purpose and duration. I keep talking about projects because oftentimes joint ventures are used for shorter term projects. You're not using a joint venture to buy and hold a rental property for 10, 15, or 20 years. You're using a joint venture to flip a property or wholesale properties. So an example of a joint venture might be 2 investors coming together to flip a home. One of them is bringing 100% of the funds, the other one is bringing all the work. And at the end of the project, they're going to split the proceeds from that house flip 50-50. Partnership structure number 2, limited liability company or LLC. Some key attributes of an LLC are liability protection, flexible ownership, pass-through taxation, and clear structure. So what do each of these mean? Liability protection means that the members' personal assets are protected against lawsuits, debts, or claims against the company. So if you have rental properties or you're flipping houses and someone tries to sue you for something that happened at one of those properties, they can sue the LLC and they can sue you for the money or the assets that are held in that LLC, but they cannot go after your personal assets such as your home or other investments you have outside of that LLC. Flexible ownership just means that LLCs can have a single member or several members, and those members can be individuals, other business entities, maybe your living trust. So there's a lot of options about how to set up an LLC. Pass-through taxation. This is really one of the big reasons why investors love LLCs over other types of corporations, because generally speaking, the profits and losses that you have within an LLC just pass straight through to the members' individual taxes, and it avoids double taxation that you might experience with something like a C corporation. And finally, clear structure. This comes through the operating agreement. If you have an LLC, you're going to have an operating agreement that outlines things like each member's contributions, their responsibilities, profit splits, and decision-making rights. So an example of how to use an LLC in real estate partnership might be that you have 2 people coming together, like Megan and Mindy, and they're choosing to buy rental properties to hold over the long term. So they start M&M LLC to buy properties and to manage those properties over 5, 10, 15, 20 years. And the operating agreement stipulates how much each of us put into that LLC, how we divide the income and expenses associated with the business of the LLC, and so on and so forth. Partnership option number 3, tenancy in common. This one is actually my favorite way to co-own property with partners over a long period of time, and I'll explain why in just a moment. But tenancy in common, or TIC, is a common way for real estate investors to jointly own property without having to form an LLC together. So here are a few key attributes of a tenancy in common: individual ownership shares, shared use and responsibility, and my favorite part, flexible exit. Individual ownership shares just means that each person involved in the tenancy in common, it could be individuals or LLCs that come together in this tenancy in common, owns their own separate interest in the property. Now, it doesn't mean, because there is shared use and responsibility, that if you buy a duplex with someone else in a tenancy in common, you own one side and they own the other side. It just means you own whatever share of that property you have, whether it's 50-50 or 60-40 with your partner. But there is shared use and responsibility. So you both have full access to use of that duplex, both sides, and you share responsibility for the expenses like property taxes, insurance, maintenance, etc. And the reason that I love tenancy in common is because of the flexible exit. Instead of being in an LLC that owns a property, and so that whole property is owned by the LLC and you'd have to unwind some things there to get out of that relationship. In a tenancy in common, you own your part and you can sell your part or will your part whenever you want to. There might be some stipulations in your TIC agreement as to how you do that with your partner. However, you could sell your 30% or 50% or 70% and the partner in your tenancy in common retains their percentage of the building. Where this gets really exciting is how it affects 1031 exchanges. If you own property in an LLC with a partner, in order to 1031 exchange into the next property, you have to still buy it through that LLC of which you and someone else are a member. However, if you buy a property with tenancy in common, you can sell your half of the property or whatever your percentage is and roll that part through a 1031 exchange into your next property. So you have way more flexibility to do things like a 1031 exchange, which for those of you who don't know is when you're able to kind of kick the tax implication can down the road. You take that investment and you flip it into the next investment. And so the government says, okay, you don't have to pay us capital gains or depreciation recapture just yet because you're still investing that money as the same individual or the same entity who originally invested it. And I think that's the biggest reason why a tenancy in common is my favorite way to have long-term partnerships in real estate. An example of a tenancy in common would be my partner Mindy and I. We work together on this channel, but we also own real estate together. And when we bought our first 8 units together, we went into a tenancy in common, her LLC and my LLC. We each own 50% of those buildings. We share income and expenses 50%, but I could sell my half or she could sell her half at any point, and the other person would still have their half of that building. Partnership option number 4 is syndication. This is when a group of investors pool their resources to buy an asset that's much larger than they could afford individually. This might be large multifamily, a hotel, or some other commercial deal. In the syndication, there's a syndicator or general partner, maybe a couple of them, and this person or these people find the deal, they manage the project, and they oversee the operations. And then there's a bunch of limited partners, and these folks just bring capital and have no say in the day-to-day operations, but they are investing in and have some stake in the property over the long term. Now, the way that proceeds are split can just be a percentage between GPs and LPs, but oftentimes there's what's called a preferred return for the limited partners. So basically this says you have your money invested with us, so anytime we make money, we will make sure you get the first X%, or you get X% every time we make money. All money made above and beyond that preferred return is then split between the general partners and the limited partners based on some percentage specified in the legal documents. And this percentage can change over time as well. There are things called waterfall structures that you can look into in more detail if you think you want to get into syndicating. But something to keep in mind is that syndications are considered securities offerings. So a syndication has to comply with US securities laws. There's a lot more involved in a syndication, bigger deals, more people, more regulation. So definitely something to look into and research in depth if you think you want to get into it. Okay, so a quick recap of the 4 different types of partnerships we talked about. Joint ventures or JVs. These are good for simple, short-term deals or specific projects with aligned partners. Limited liability companies. These are great for long-term partnerships and holding properties where you need liability protection. Tenancy in common or a TIC. This is great for when you want that more flexible exit from a property where you can sell your share, the other owner keeps their share, and it's great for 1031 exchanges down the road when you're not sure if you're going to want to continue to work with this partner until you're done investing. And finally, syndication. The best for raising capital at large scales using passive investors. So there you are, 4 ways that you could partner on your first or next deal in real estate. Do you have a favorite partnership method that I didn't cover here? Please comment below. We'd love to see what you're doing as partners in real estate. If you found this helpful, please subscribe and share. And most importantly, keep learning, keep growing, and have fun.